Have you heard a private or hard money lending company state that they are a direct lender and wondered what that means and why it matters? In this video, I'll explain what makes a lender a direct lender, how it affects the loan process, and how to find direct lenders that offer private mortgages for both commercial real estate and residential investment properties. I'm Butani, CEO of PrivateLenderLink.com, where investors and brokers can easily find direct, private, hard money lending companies. If you're in the investment real estate business and want to gain insights into private mortgage lending, subscribe to our channel and get notified every time we release a new video. The meaning of a direct lender is subjective, and you may hear several different opinions on this topic. The easiest way to define a direct lender is a loan originator that funds loans from their own balance sheet, meaning they have the funds in their bank account and they wire the loan amount at closing. However, it's not that simple. While there are many private mortgage loan originators that do fund loans using their own balance sheet, there are a few other capital structures used in private lending which, in my opinion, are still direct lending. If a loan originator is not funding the loan from their own bank account, they are likely using one of three capital structures to fund the loan. The first structure is what I call one investor, one loan. The loan originator underwrites the deal, and one high net worth individual investor or family office will wire the funds at closing. These investors only work with loan originators, so you can't borrow from them directly. The second structure is a syndication, meaning the loan originator underwrites the deal and raises capital from multiple individual or family office investors who all wire a certain fraction of the loan amount at closing. And the third structure is a capital partnership with another private lending company. In this scenario, both the loan originator and the capital partner underwrite the deal together, and the capital partner wires the entire loan amount or the majority of the loan amount at closing. In all three of these scenarios, the loan originator is not using their own balance sheet to fund the loan, so you may argue that this is not direct lending. However, in my opinion, it is still direct lending if one key condition is met, and that is the investor or capital partner is not charging an origination fee, also known as points. When the lender is ready to commit to your loan, they will provide a term sheet or LOI, and this document will state all the fees that the lender charges. If the document shows that another company or entity is to receive an origination fee, in addition to the lender who you're communicating with, that to me is not direct lending. This scenario could be considered brokering, but it's more likely that the loan originator has a wholesale or correspondent partnership with a larger private lending company, which also offers retail lending directly to real estate investors. The whole topic of being a direct lender is mainly a concern for mortgage brokers. But if you're a real estate investor, it may not matter because you won't always get the best terms from a lender just because they are direct. Don't worry so much about where the money is coming from. Instead, focus on the terms offered by the lender. I recommend you get 2 or more term sheets and compare them. You may find that the loan originator who has a capital partnership with another lender offers better terms than a direct lender. Because what typically happens in capital partnerships is the lender who is actually funding the loan will reduce their origination fee down to half of what they normally charge so that the loan originator can charge an origination fee as well and still make the loan fees competitive as a whole. And if you try to circumvent your loan originator and go directly to that capital partner, you likely won't save any money. So how does working with a direct lender affect the loan process and the time to close? You might assume that working with a direct lender means that your loan will get funded faster, but that's not always the case. Loan originators who get their capital from multiple investors, or the ones who have a capital partner, may be able to fund just as fast as lenders who have a balance sheet. There's a lot of capital available in private lending these days. Serious investors and capital providers are ready to deploy their funds right away and don't want to miss out on a good loan. If there's an urgency to close a loan in 3 days, the lender should be able to tell you up front if they can make it happen. It doesn't matter so much whether the loan originator is a direct lender or not, so long as they can execute and get the loan funded on schedule. If you're looking for a private or hard money lender, use our website PrivateLenderLink.com as a resource. There's no fee to search, and almost all the lenders you'll find on the site are direct lenders. You can view each lender's profile to learn about their guidelines and reach out to them directly. Being a direct lender is the main requirement to be listed on our website, and the reason is many of our site's users are mortgage brokers. Although some of the companies listed use capital partnerships for certain types of loans, all lenders are only allowed to promote their direct private lending programs on our website. 2 search categories on the site have exceptions to this rule: residential owner-occupied and small business lenders. If you found the content in this video to be useful, please click the like button and be sure to check out our other videos about private and hard money lending. Thank you for watching, and see you in the next video.